April 18th, 2018, for the Stout webinar entitled Financial Analysis for the Boardroom. My name is Jennifer Ballback, and today I'm joined by my colleagues and our presenters, Christina, Carroll, and Marc Asbra. Before we get started, I wanted to address a few administrative items. All participants on the line have been muted. Please utilize the questions function on your webinar screen to ask questions. If there are questions we are unable to respond to during the session, we will follow up afterward. This presentation will be recorded and the slides will be circulated to attendees after the event. Now I'd like to introduce our presenters. Christina Carroll is a managing director in the Valuation Advisory Group at Stout. For more than 20 years, she has been a board and C-suite advisor on complex transaction and strategic issues with a focus on evaluating transactions and assisting clients in enhancing shareholder value. Marc Asbra is a managing director in the Valuation Advisory Group at Stout as well. He has over 20 years of experience in the valuation of businesses, securities, and intangible assets for corporate tax, financial reporting, and other purposes. Thank you for your attention. Chris and Marc, over to you.
Thanks, Jen. Good morning, everyone. First of all, I'd like to get us calibrated on our topic this morning and give a little bit of background on the series, Financial Statement Analysis for the Boardroom. Originally, a law firm organization made the observation that GCs are often having to review and comment on complex financial analysis in either standard board packages or in board packages where they're reviewing transactions. And GCs who don't have a financial background can often feel uncomfortable with the process and the mechanics of financial statement analysis. So we basically designed this program for GCs originally, General's Counsel, and we haven't, and what we've found is that a lot of other professionals who don't have a financial background and are in the boardroom have a need and find the material useful. Today's presentation is the second in a part of the series financial statement analysis, and it's the intermediate level. If you're interested, you can review the basic financial analysis webinar on our website at stoutadvisory.com. In today's presentation, we'll delve a little deeper with a specific case study example evaluating the divestiture of a business unit. I'd like to turn over the presentation to my colleague, Marc Asbra.
Thanks, Chris. Maybe to start, just in terms of the context of the webinar, we've got three main components of the presentation. The first, we'll walk through a case study, as Chris just suggested. We'll go through some framework for analyzing the company. And the second and third elements of the presentation will address a specific transaction that the company is contemplating. So we'll go through some assessment of that potential deal and evaluate the impact of that transaction on the company's performance. So start with the analysis of the company. This is, as I say in the movies, based on a true story, I would say. This is a real-world Stout engagement or client of the company. It's involved in the manufacture, design, and ultimate marketing of branded fashion apparel and related accessories. This is a public company. The company has been around for about 20 years, went public about 12 years ago. It's got operations, wholesale operations, importantly, across the U.S. And it's had a good run. As you'll see here, there's been some much areas that have been celebrated in terms of success. And the company has largely grown through organic growth. It hasn't undertaken any significant, transformative transactions over its history. But as we say here, much like others that are in this sector, our company here is facing what we say is some headwinds or some strategic challenges, but at the same time, we would say that it is not facing or showing any signs of severe financial distress. So what you're looking at here, to kind of get into some of the analysis, maybe just a couple of quick observations, and I'm going to set some framework here. What we're looking at here is a 5-year history on a summary basis, not very different than what might accompany a board deck if you're in a boardroom, looking at some of the first couple of pages, high-level observations on summary performance. Here we've got some income statement data at the top portion of the page, as well as some calculations that show some growth rates and some other common size or margin information. So before we dive into some of the analysis there, if a page like this hits my screen from an analytical point of view, I tend to approach that analysis from a cause and effect framework, meaning the information that we're looking at on this page are really the effects of a whole bunch of factors that are impacting the company, a whole bunch of causes, if you will, that are impacting the company from its operations, its strategy, other decisions that its executives make from an internal perspective, as well as the marketplace, from competition, regulation perhaps, and a whole host of other factors. So I would typically look at both of those views, and I find that I do that with really a kind of a two-step process. From the effects, I want to first make some what may even be simple observations based on the data that's presented to me. So make those observations, maybe formulate some hypotheses as to the potential causes of the effects that I'm seeing on the page. And then I will also formulate some internal questions, things I want to investigate. The second step of that process, at least for me, is to then typically dive one level below the information that I'm looking at. And I'm going to do that in an effort to answer those questions or glean additional insight on the effects that I'm looking at, or the observations that I've made on the first portion of that process. And I do that because I think that it helps me focus much less so just on the financial metrics and get some insight into the business issues that our clients or this company is dealing with. So let's kind of dive in. So some initial observations here on this page 6. We got a 5-year time frame. Overall, when I look at the revenue on the top side, we've got an increase in revenue over the 5-year period of time of about $60 million, give or take. As I look at the revenue growth metrics on row 6, this company's actually had a pretty consistent annual growth rate, at least in total, of about 5% per year. A favorable metric, particularly given some of the challenges that apparel companies have had in particular. As I drive down the P&L, though, and I look at row 3 in terms of the gross profit metric, I see that the gross profits increased only about $2.5 million over that same period of time. So as I think about a $60-ish million revenue increase and only a $2.5 million gross profit increase, I'm going to see, as I expect, on row 7 and 8, margin compression. So we see on row 8, the gross profit margin of the company has declined pretty significantly over this period of time, from almost 58%, almost 9 percentage points over the 5-year period of time. That's significant. As I go back up to the income statement data and I look at operating expenses, I see something similar there, where we've got an increase almost about a $4 million amount. So operating expenses in dollar terms have increased over the 5-year period of time, but as expressed as a function of total revenue here, again, as we see on row 9 at the bottom of the page, the operating expenses as a function of revenue have actually declined. So when we think about costs and gross profit and the operating expenses, what we see from an EBITDA point of view is, while it's declined from $34 million in 13 to just about $32 million in the most recent year, the margin has declined, but not as much as the gross profit margin would indicate. So we think about some scorecards here. I'd give a positive star, if you will, to the revenue growth rate and the company being able to grow in this type of environment with this type of sector to the tune of consistently 5% per year. The margin decline at the gross profit level is clearly an area of concern and warrants additional investigation. And that green arrow, simultaneous arrow that I have on the operating expenses and the EBITDA is kind of a push. It's more of a neutral view. I mean, the company has been able to at least do some things on the operating expense side to manage those and to otherwise not have the same type of significant EBITDA decline that we're seeing at the gross profit level. So first observations, now let's dig into the second step, kind of go one level below and look at some of the factors that are at least impacting revenue, which can be deconstructed between volume or quantities and price. We'll start with some thoughts and observations on volume. So we see here on page 7 toward the top of the page, we've got this company selling product through a number of different channels. The major retailers here, we're talking about Bloomingdale's, Macy's, Nordstrom, those types of big box retailers, which is clearly the lion's share of the company's volume, but we see it decreasing pretty significantly over this period of time. The specialty retailers are going to be smaller, more boutique types of shops that have a much smaller footprint, and tend to cater to a different type of consumer, a different type of customer service process, much smaller contribution here. I can see from an online perspective that this company is selling product there, and it is in fact increased pretty significantly over the time horizon here. And then importantly, this company is also, even though a branded apparel company, is selling product through an off-price channel or an outlet store. So off-price there would be companies like a TJ Maxx, or discounters, TJ Maxx, Marshalls, Nordstrom Rack perhaps. So some scorecards here, when I think about volume contribution percentages, the change in the majors is a significant change to the business, going from almost 70% of volume in 2013 down to less than half, or less than 45% in the current year. The specialty retailers, I kind of give a push or neutral there. I mean, it's a smaller component. The actual unit volumes have increased in quantity, but from a contribution percentage, they've actually declined over the period of time. Clearly, I think a star should be awarded in the case of the online, contributions here, just reflective of the company's push and higher volumes and growth rates that they're achieving in the online channel. And then a neutral on the off-price and outlet stores. And I have a neutral there because as much as there's a positive view that there's higher volumes, as well as the contribution percentages, over the time horizon here, the dynamics of an off-price channel or selling to outlets can have broad implications on other areas of the business that would need to be assessed. And we'll get to that in just a minute. So the other side of the revenue equation, we'll talk about ASPs, or average selling prices, broken down by the same channel. So some initial observations at first step. We see some declines, significant declines in the case of the major retailers, as well as declines in the specialty retailers, although not as severe as what we're seeing in the majors. So the combination of lower volumes, lower quantity on the majors, and significant price declines is clearly moving things in the negative direction. The offset to that is going to be on the online side and the off-price, where we actually see price increases over the time horizon here. So that, I think, is a positive metric. The other couple of observations, maybe as you'd expect to see, the product that the company is selling through the specialty retailers consistently has the highest price point. Whereas the reverse is true in the case of the off-price and outlet stores. There's got to be product there that's going to be sold at a lower price point relative to some of these other channels. And the other observation here that I think is kind of noteworthy here is that when you look at what's happening with the online ASP and the major retailer ASP, where most of the product is being sold, we're actually seeing more convergence in those ASPs. So scorecard here, probably not surprising. The declines in the major retailers, clearly an area that warrants a significant, more investigation and has an area of concern, frankly. Specialty retailers get a push. It's decreased over the time horizon, but maybe not as much as might otherwise be warranted. And in the case of the online and off-price, the fact that the company's been able to implement or otherwise achieve higher price points over the time horizon here, I think is a positive view. So we put those two together, the volumes and the ASPs, we get a sense of how actual revenue dollars and some of the changes are shaking through each of the distribution channels here. So there's more of the output for those pages that we just walked through. So interestingly, as much as we started in the first page and seeing the 5% revenue growth per year very consistently, and we see that same numbers on row 6 here, when you think about what's happening from a mix perspective, it tells a completely different story. We've got huge declines on the major retailers and some marginal declines on the specialty retailer size that are being, masked, if you will, or offset by increases in what this company's been able to do online and through some of the discount and outlet channel. So let's do the same thing. We'll go through a similar exercise with respect to costs. So the kind of corollary to the average selling prices that we just walked through, we'll do the same for the cost per unit. So again, step one, some observations on the data that we're seeing on page 10. What we're seeing is some increasing costs. Costs generally do increase, particularly for these types of things in terms of material, labor, distribution. And we see on an overall basis, costs are consistently increasing across all categories, or I should say across all products that go into each of these different channels. And on a weighted average basis, a little bit under 2% increase in terms of the cost per unit per year. So we think about increasing costs overlaid with, particularly on the major retailers and the specialty retailers, and the volume declines there and the declines in the ASPs, we're going to see, like we would expect, the gross margins at the bottom of the page to show the compression that we're talking about, and particularly on the majors going from almost a 60% margin down to a 48% gross margin is significant. So scorecard here on the cost per unit, I've got a question mark. On the data that's presented, it's tough to really say whether or not this is good, bad, or indifferent. I think warrants additional investigation, and I say that maybe because the costs here for some of the materials and other components that go into some of these products could have increased more. Maybe the company identified some problem areas there, identified the changes that they were seeing in terms of volume declines and pricing pressure from a consumer perspective, and did some things to mitigate cost increases that might otherwise transpire. So kind of a to be determined in terms of the evaluation on the cost side here. So let's go down to operating expenses. Similar thing, step one, let's make some observations about the data that we're seeing on the page. We can see that far and away the largest single category here is selling and marketing expenses, which probably should come as no surprise. We think about a branded apparel company is got to have to spend a significant amount of money promoting the brand and promoting product, and we see that here. The other categories, some rent, some IT types of expenditures, and we've broken out some compensation between executives and just everyone else, and some other kind of catch-all categories. So observations, selling and marketing. The fact that we have a growing revenue stream to the tune of about $60 million in total over the 5-year horizon, and increases, or should say decreases, in an absolute dollar spend from $58 million down to $56 million on the selling and marketing expenses is noteworthy. We see, though, kind of reverse true on the compensation for the executives, increasing by about $2 million over the time frame here, and flat compensation for some of the others. So one other thing I think is helpful here, much like we looked at gross margins, and we were talking about gross margins earlier, we can do the same thing from an operating expense perspective and look at these operating expenses expressed as a percentage of total company revenue, and it gives us some additional insight here. So to the company's credit, on an overall basis, the total operating expenses, while they've increased in dollar terms over the period here, they've actually decreased at the margin, from at the very bottom of row 14, from 45% down to about 39%. So our scorecard here, in terms of some observations, I'd say an area of concern, seeing the compensation for some of the executives increasing in terms of overall dollar terms, given some of the headwinds and other dynamics that we've seen so far. We've got an increase in the overall rent expense that I've highlighted in 2015, which is attributable to a move of the company's headquarters during this period of time, which maybe could be questioned, given again some of the headwinds that the company is facing. And the other G&A, again, it's a catch-all category. The fact that we often see in our clients that expense category tends to run up every year, as opposed to what we're seeing here actually going down in terms of dollar terms, I think is a feather in the cap of the management to make sure that those expense categories just don't, continue to increase blindly at, 3 or 5% per year. And on the selling and marketing, I got an arrow there that just warrants the fact that it's a big spend. It's the biggest, single dollar category, and warrants some additional investigation to really kind of assess what's happening there. So if we do that, and we took that selling and marketing expense and break it down one level below into some of its components, we see that sales commissions are far and away the largest, the lion's share of the category that comprises this expense area. And the others are various forms of advertising programs, either print or other, which is mainly social media that the company has done, as well as investment in online types of programs. And this company, like in fashion, like many do, has a pretty big commitment to doing trade shows on an annual basis. And like we just talked about on the prior page, we'll do the same thing in terms of margins to see that actually a lot of these expenses, not all, but a lot of the larger ones are actually declining at the margin. So the company is ratcheting back or otherwise scrutinizing the amount that it spends on some of these categories. So the scorecard here, the sales commissions, I had an arrow there just to notice that that's an area of additional concern. It's decreasing. A question that comes to my mind is, one, why? And whether or not it's a function of the mix of revenue. I mean, sales commissions may be typically being compensated more so by volumes generated by the major retailers and specialty retailers, as opposed to online channels and the off-price channel. The advertising related and the trade shows, I got a question mark there just because it's tough to assess. Maybe unlike the online programs, where we see the company has allocated significantly more dollars in its sales and marketing budget to the online programs, and we're seeing the payoff in this company's performance by virtue of the very strong growth in revenue and price points in their online sales. The print and other types of media advertising, trade shows, it's hard to attribute the spending there directly to any of the channels that the company is selling through, at least based on the data that we have so far. So to be determined there. So some of these things we just walked through, I think we're able to glean some insight into what's happening with this company, right? We've got a company that's undertaking some significant change in its mix in terms of how its product it gets into the hands of consumers and some of the implications that it has on what's happening in terms of price points, the ASPs, as well as costs, and where the company is spending, its selling and marketing dollars. So we got insight to some of those areas, but there's still some questions that are going to be, unaddressed at this point. So some, in my mind, a few of those that hit the radar screen would be going to the major retailers. What is management's plan to kind of, combat or address the underperformance in that channel on both sides, volume and ASPs? And as we think about this company increasing, sales through some of its other channels, the other questions become, well, if there is any expectation to turn around the sales volumes in the major retailers and even specialty retailers, do we have to worry about potential cannibalization or brand dilution, particularly as it relates to pushing product through the outlets and the discount channels or the off-price channels? And finally, or a couple others in terms of whether this company on a channel side has been able to push product much more so through online. The question is, and it's been favorable in that regard, is there a more of an opportunity to increase its online sales? And addressing the cost side, I mentioned before that was kind of a push there, hard to evaluate. So that would be my question to the management team. Look, the overall costs are increasing by about 2%. Have we done everything? Has the company done everything to rationalize materials, maybe the design process, outsourcing potentially, in an effort to potentially combat the declines in the ASPs that this company is experiencing? And related to that, supply chain. Have we fully optimized the supply chain? As we're moving toward expenses that are very important to this company, more the operating expenses, they go right to selling and marketing. So is this company, has our strategy, does it need to be reassessed in terms of what they do or where they spend or allocate their selling and marketing budgets in light of what they're seeing in terms of the overall marketplace or the mix of their channels? So, and is there at some point, there as much as it might be favorable that this company has been able to scale back spending on some of its selling and marketing programs to kind of combat the losses at the revenue line or on the gross profit line? Or that might be favorable in one case. It raises the question that at some point, is this company going to be facing some potentially negative implications as it relates to the brand as a result of depressed spending? And then lastly, from a compensation point of view, it's changing. So the mix is changing. Is this a period of time where the company kind of needs to reevaluate how it motivates and rewards, particularly its salespeople, in making sure that they're, incentivized to and aligned with the company's goals in that regard. So we talked a lot about, in a couple of cases, drilling, one level below financial analysis or financial data that's presented on a page. We did that from an example from a revenue perspective, looking at, volume and price or quantities as the case may be, and you can go down to different layers as well. And on the price perspective in particular, that could be broken down into things like channel and brand and some of the other kind of impacts or things that impact the demand. So I would say financial analysis in my mind it's not like peeling an onion. I mean, there's no benefit to getting at the center of an onion. I say financial analysis is more like peeling an artichoke. So you kind of peel back layers, and they get better, and you get more insightful as you go through that process. So Chris, I'm going to stop there on the company side. I'm going to turn it over to you, and we can talk about the transaction.
Yeah, thanks, Mark. So Mark took us through in section 1, analyzing the company, really looking overall at some of the trends and margin and growth and so forth. And, just to make the observation, the company was obviously performing poorly, had some headwinds. And so oftentimes in the boardroom, when you're looking at this kind of analysis, the board starts to think about what are the overall types of transactions that we could go through. We could go private. There's lots of different types of transactions, but often also we'll look at each of the business units, product lines, et cetera, for sort of what might be bringing down those results. And oftentimes the board will be in a position of looking at alternatives like, should we divest of a product line or business unit, spin it off, carve it out, shut it down, or what have you, in terms of improving the overall performance. In terms of, just trying to advance the slide, there we go. So in this particular case, there was a business unit that was focused on accessories, and it was really languishing in the shadow of the primary business, which was core apparel, and it really wasn't meaningfully growing, or even their outlook was even pretty poor as well. So it really set up for a classic situation where you could carve it out or spin it off to either a private equity group or strategic buyer, where under that type of direction and care and attention could perform better. In this particular case, it was somewhat lost in terms of the strategic direction of the overall company. So in our example here, there was an unsolicited offer from a strategic buyer. It was a cash-free, debt-free transaction, and the price on the table was $21 million in cash. So in terms of assessing the reasonableness of this $21 million offer, we looked at the business unit itself, how much in terms of contribution from a revenue perspective, what did the cost and expense profile look like, and what kind of margins are available. And what jumps off the page really here is that the business unit really was contributing a 2.7% EBITDA margin in light of an overall business or an overall company EBITDA margin of 9.7%. So if we think about hiving that underperforming business unit off, what you would be left with is a business that is performing at an 11.1% EBITDA margin. So sort of this immediate improvement in terms of margin. If we look at the red box below, what we've added here is some multiples. So we know that from the public company market cap of $265 million, we know that the implied enterprise value to revenue multiple is 0.8, and that the implied enterprise value to EBITDA multiple for the company overall is 8.3. So we know that because of its trading. And then if we think about this business unit, we have this offer of $21 million which if we just focus in on that operating performance and offer, what we find is that that's a lower enterprise value to revenue multiple on line 8 there of 0.38. So it's below where the overall company is trading, but if we look at line 9, what you observe is that offer is actually a 14 times EBITDA. And it goes part and parcel really with the lack of profitability in that business in terms of thinking about that revenue stream, and it's trading at a lower level, but they're giving a fair amount of credit in terms of the EBITDA multiple. So again, in terms of assessing the reasonableness of this, we now take the next step of looking and comparing to some of the public company multiples out there. And what you see on page 23 is 8 different public companies that are largely in the branded apparel and accessory business, and they trade anywhere from, if we look over on the right-hand page, right hand of the page, the LTM EBITDA, they trade anywhere from, on line 8, 6.2 to 17.7 times EBITDA. And then from a sales perspective, it's a very, very wide range, anywhere from 0.25 up to 2.72. So for this particular industry, we really sort of discount those sales multiples and focus in more on the EBITDA multiples. And if we pause for a minute on line 14 and look at the EBITDA multiple that is offered in that $21 million offer, at 14 times, it's not only above the average multiple of 10.7 or even the median of 10.2, but it's near the top end of the range for the multiples of the public companies. And this is a pretty small unit as well, so you have to factor that in. On the next page here, on page 24, again, we're trying to inform ourselves what is the right multiple, or is this a fair multiple for this business unit to trade at? And so we peel it back, as Marc described, again, and try and inform ourselves, well, how is this sector trading? And if we look at margins for a moment, the margins range anywhere from 4.1% to 16.2% at the high end. So a fairly wide range. And if we bring it back to our business unit, it's got an EBITDA margin of 2.7%. So they're not even in the range. They're below the range in terms of the margin. So one would think that the multiple for the company would be probably lower than the range, just based on this data. If we then layer on growth, what we find is that, again, there's a wide range of growth statistics here for the comps. It's been a tough overall year. If we look at the one-year growth rates for revenue and EBITDA for the companies, many of them have shrunk. And our company actually, on a historic basis, grew 5%, and the business unit was essentially neutral or slightly down. From an EBITDA perspective, we also look at the growth of the EBITDA, and what we find is, if we focused in on, for example, the bottom of the barrel there of the public comps, Fossil on line 8, their revenue and EBITDA declined 8% and 54% respectively, and the outlook is also not very strong. It's a decline of 1% and a decline of 18%. So that informs us as to why are they at the bottom of the range at 6.2 times EBITDA in terms of their trading multiple. And if we contrast that with, say, the VF Corporation, which is our largest comp on line 5, what we find is that although their growth, if for the last year has been tough. They're expecting a rebound in the forward year, almost 3% in terms of revenue growth, and a pretty healthy EBITDA growth for a company this size of 6.7%. So they're expecting a rebound, and you could argue that that 17.7 times EBITDA that they trade at is perhaps a little bit inflated due to the expectation of higher earnings in the future. And so that's just a little bit about, you know, how we think about from a growth perspective and from a margin perspective, what might be driving these multiples for the public comps. And again, in comparison, we look weaker than these comps pretty much across the board. And so our preliminary assessment would be, gee, that multiple looks pretty attractive, that 14 times latest 12 months EBITDA. On the next page, it's not, there we go. For some reason, it's not moving forward. Someone could advance the slide. Okay, there we go. So comparable M&A transactions. So when we're evaluating an offer, we not only look at the guideline public comps, but we also look in the marketplace for change of control transactions, where either a public or a private company has sold. And so oftentimes the data that's available is not as fulsome as you would find for public comps because of the reporting requirements that they have. So you see some NAs here, but we do the best we can in terms of the information that we have. And quite a few of them have EBITDA multiples available. And those EBITDA multiples range from 5.8 to 13 times. And if we then layer on the margin, EBITDA margin, they range anywhere from 9.9 to 16.6% in terms of EBITDA margin. So here again, when we look at public comps, our business unit with a 2.7% EBITDA margin in light of the range of these transactions, it's lower, it's a weaker performance, and therefore you could argue that their multiple should be below the range, and when in fact it's actually above the range. So again, it looks like a fairly attractive offer as we sit and just look at those parameters for the company. In terms of observations, again, this looks like on first glance that it is an attractive offer. It's something that obviously you need to do your due diligence and kick the tires a little bit further on, make sure that it has certainty of close and whatnot. But on a comparison basis, if you look at the guideline public comps and you look at the control transactions in M&A, it looks like a good offer. And so that would allow in light of a divestiture of that entity, it would allow the company management also to focus in on its core business. Marc, over to you.
Thanks, Chris. All right, so Chris just walked through that transaction, kind of just some overall assessments and some initial observations. So we'll do the same as we started at the financial analysis section here, and dig one level below, and really try to evaluate the impact of this deal on the company performance. But before we do that, as we dig one level below, what we see on this page 29, the before sale metrics are exactly those that Chris just walked through. But as we peel back one layer of the artichoke, if you will, we see that the business unit in particular, or the business unit in question, its cost structure from a company reporting perspective actually has $2.5 million of allocated expenses to it and $250,000 of allocated CapEx, or capital expenditures. So if we think about this deal from a direct versus allocated perspective, and we say, well, look, if they do this sale this business unit, it's really the direct elements in terms of revenue and cost that are going to leave the building. So if we look at it from that context, is that 14 times multiple that Chris mentioned, as we see down on row 9 here at the far right column, that 14 times multiple suddenly becomes 5.3 times multiple. No change to the revenue, but the EBITDA is materially different by virtue of the removal of those allocated costs. Those allocated costs they're boomerang costs. They go back to the company. So when we think about before this transaction or before this potential sale of the business unit, we see on the left-hand side, this is our company that's generating roughly $32 million of EBITDA. Well, what's going to happen, to the company on its totality, if we sell this business unit? You can see, as we kind of summarize in the red box at the bottom, that that $2.5 million is, again, the boomerang. It comes back to the company. So while the disposal of the business unit is going to increase the EBITDA margin on a consolidated basis, we see that on row 4, the 9.7% margin going up to 10.2% margin. So margin is going to improve, but revenue is going to fall. EBITDA in dollar terms is going to fall. So how do we think about, what is going to be, or how the market might react to this sale transaction? Are we going to, is the company going to see some uplift in enterprise value? How will the market, price the company post-transaction? We don't know, based on, no one ever knows, frankly, in terms of how the market's going to react, but we certainly don't know in this case. So we think about, two things from an impact, evaluating the impact of this deal from a company performance. Let's talk about value first. So this is our first view, if you will, the before sale transaction of our roughly $32 million of EBITDA. The implied multiple of 8.3 times based on our company's $265 million enterprise value. If the market rewards the company with that same 8.3 times multiple, we're going to lose the $4 million of direct EBITDA profit that the business unit is generating. And if that's the case, same 8.3 times multiple, the enterprise value of our company is going to decline by about $33 million. Now, the company will be able to offset that decline with $21 million of transaction proceeds. There's actually negative economic benefit, if you will, or value detriment from a shareholder, from a company perspective under these sets of assumptions. So we think about not so much only in the case of is the deal multiple a good number or a fair multiple. There's also just the overall view that this transaction, while we're getting $21 million of proceeds, we're actually giving up $4 million of annual EBITDA. So we had a second view. So the same metrics on the first side, but if we said, well, what if the marketplace is not going to keep the company's multiple the same 8.3 times? Instead, we're going to see some uplift because of either the higher profit margin that we talked about earlier, or the company potentially being able to do different things with the proceeds from the transaction, or otherwise focus more on just growing its core fashion business. We get an uplift in the multiple, if you will, to 9 times in this example. So clearly, that 9 times is better than 8.3. We're going to see still a decline in the overall enterprise value, but less of a decline compared to the overall transaction proceeds of $21 million. So under this view, we actually see that there's some positive economic benefit to the company. And further still, if we say, well, we focus on the costs, if you will, the $2.5 million of costs that were previously allocated to the business unit, that results in a $4 million EBITDA loss if they do this transaction. Well, what if the company is able to focus on some of those $2.5 million costs, or rationalize maybe some of the folks that were spending some of their time on that accessories business unit, and otherwise cut costs? So we're not talking about a $4 million delta in EBITDA post-sale, but a $3 million, then clearly with a 9 times multiple, we're, again, still seeing a decline in the overall enterprise value of the company, but much, much less so compared to the $21 million of transaction proceeds from the disposal of the business unit. So that's on the value impact side. If we think about also from a financing perspective, what does this sale transaction mean, or what the implications to the company? We think about, debt service or debt coverage in this case. Our company here has got $105 million of debt. So we think about before the deal, there's $32 million of EBITDA. We got we call a debt to EBITDA coverage ratio of 3.3 times. post-transaction, this shows our $4 million decline in the direct contribution profit, EBITDA, of the business unit. So EBITDA is going to go down to about 28 million, and our debt to EBITDA coverage ratio is going to go up by half a turn to 0.5x. That's a meaningful increase. So similar to what Chris just walked through in terms of how we evaluate a deal multiple or a deal price, we'll do the same thing from a financing impact, at least to start. We'll go back to our public companies, just from at least the perspective of assessing from a peer point of view, how did our company compare to what we're seeing in terms of the public domain? So a couple of observations here. Interestingly, even before this transaction on row 13, we see that our 3.3 times coverage ratio, debt to EBITDA, I'd say is within the range, clearly on the higher end of the range that we're observing with these 8 public companies. But a couple of things to point out, as Chris just walked through, Hanesbrand and Fossil Group, while their debt coverage ratios, the debt to EBITDA ratios, are very similar to one another, I think if you looked at the overall financial metrics of each of those companies, you'd see that Hanesbrand is probably more of a stronger performer than what we see in the case of Fossil Group, meaning the Fossil Group enterprise value and its financial metrics are being much more challenged than what we're seeing in the case of Hanesbrands. So a little bit more detail to kind of continue to go one level below. We look at kind of debt to enterprise value. So this is more of a financing type of question. So of the total enterprise value of the company, how much of that is coming from market cap in equity versus debt? And we think about that. We don't know what this company is going to trade at post-transaction, but we do know where it's at right now. So on row 13, we see that the debt as a function of that $265 million of enterprise value is a significant number, way above what we're seeing in terms of the rest of these public companies. So it's a helpful metric. Is this peer group analysis to at least to calibrate where this company is at and where it potentially could go if it goes through with this transaction, but it's clearly not the end all be all. In fact, when we think about debt and we think about decisions about transactions and the debt that corresponds with those, or at least what to do with the debt that remains with the company, we look on page 36 and look at kind of the debt service capacity. So similar metrics that we just walked through in terms of debt is the 105 million and the EBITDA pre and post sale. But here we're going to drive down a little bit further in terms of not only stopping at EBITDA, which many people look at as a quote unquote proxy for cash flow. We know it's not true cash flow. So what this analysis is doing is saying, well, company doesn't pay debt service, principal and interest out of, some non-cash or, some EBITDA level. You pay it with cash. So let's get some insight in terms of after-tax cash flow. So we drive down the P&L and take into account depreciation, tax shields, and interest expense and taxes. And importantly, on row 11, capital expenditures, which are not an inconsequential number for this company. And when we do that, we see on row 13 and 14 kind of similar types of debt or solvency related metrics. The amount of coverage that this company has on its interest expense being generated by EBIT, would decline from 3.2 times before to 2.8 times afterward. And probably more importantly, I would say the debt as a function of this EBITDA minus the CapEx, so taking into account the roughly $4.5 million spending, that debt to EBITDA minus CapEx increases to about 4.5 times post-transaction. So that's not going to leave or may not necessarily leave the company with a lot of financial flexibility going forward, particularly if it's faced with additional headwinds in the future. So some questions. If I was looking at this analysis, or you see some of those financial metrics put in front of you that have a business unit or product line or something, in my mind, one of the first key questions is cost. How are they allocated? There's not a one size fits all type of view on how to do that. So that would be key to understand. Is that $2.5 million of allocated cost in this case? How's that number derived? Now, what are we talking about there? And related to that, if we retain this business unit, the company does, are there things that management can do to improve the growth profile or otherwise improve the profitability and reduce some of those costs? And similarly, even if they sell the company, sell the business unit, that is, that $2.5 million of cost comes back to the parent, if you will. are there areas where the company really can, rationalize some of those costs and improve the profitability overall of the company? And then last, or at least one other element here in terms of the case of the sale, much of the overall economic decision as to do it or to not to do it, as from a shareholder impact perspective, is going to depend on, what assumptions are made with respect to how the marketplace is going to trade the company post-sale, or how they're going to view the company post-sale. So what's the degree of management's confidence around, getting a higher multiple if they dispose of this, underperforming smaller business unit? So, and then last, in terms of questions, is what to do, right? So we do this, if the business unit is sold, what's the company going to do with those proceeds? Pay a dividend, or retire debt, or pay down debt, or potentially invest in other, growth areas of the business? I don't think we know enough here based on the, schedules here, but that, the typical kind of questions that a management team is going to be faced with. So maybe to summarize what we've been talking about here, because we've seen it in a couple of cases, really throughout the presentation, in terms of, digging deeper, one level below financial information that's presented on a page, peeling back the layer of the artichoke, if you will. Is always the ability to do that and gain additional insight and help identify business issues. The key, as we say here, is to dig deeper, but avoid analysis paralysis. And that's where you have so much data, you keep digging and digging and digging and digging. You got too much data at that point, and now you're paralyzed. You can't make decisions from the data, and you just kind of get lost. So our recommendation, when we try to keep this in mind as a trade-off, is to focus on the key performance indicators. What is this company? What is their nature? What did they do? And what really is their focus? So here we've got a branded apparel company. I'm going to focus on volumes. I'm going to focus on channel. I'm going to focus on things that impact the brand, pricing, and sales and marketing. That's where I'm going to really focus my time and attention and dig deeper in those areas. From a transaction perspective, or really any strategic decision, it's kind of a cost benefit. So you can look at initially and say, well, what do we think this deal is going to provide in terms of value? Does it seem right? Does it seem reasonable? Does it seem fair even? And you can look at those things, as you should, but we would say you wouldn't stop there. You need to focus on, well, what are the impacts to the company, and what do we lose if we do this transaction, even if it's a quote unquote fair deal? How's it going to impact the company? And then lastly, as we're going through some assessment of the impact of a strategic decision or some transaction, or any type of financial analysis for that matter, we need to focus on, at least recognize, what do we know? What items do we don't know but are knowable if we do some additional analysis or investigation? And what items do we not know? Like we were talking about here in the market reaction to this transaction. What are just guesstimates or speculation as to what that reaction is going to be? And you got to identify what those are and put confidence, either weight them to things you know more, or weight, if you will, and from a time perspective, and analyze things further in order to make the right decision. So Chris, any other kind of closing comments from your perspective?
Marc, I think you summarized it well. I think, as we go back to our original idea that this was designed to help people without a financial background really sort of get some basic understanding of financial analysis. And really, I think hopefully this presentation has helped at least lay the groundwork of okay, we look at the financial analysis, and that sort of informs us what questions to ask and so forth, and once we analyze those trends. So I don't really have much more to add. So
okay. Jen, I don't know if from your perspective, if we've gotten any questions from the audience that we can address here. We've got a few minutes.
Yeah, sure. Let me take a look right now. Yep. So we do have a few. Okay, so I'll just start at the top. Among all of the factors impacting revenue, is there one single factor you find most concerning?
Marc, I would say for me, probably the off-price and discount channel. And I say that just because it is when we see from our other apparel clients, it's a tough balancing act. Meaning, particularly for a company that's got a premium brand, you want to protect the pricing, and you want to protect the consumer's recognition and just how they perceive your brand. So where they can buy product matters to the brand. So a company that's able to do that well, meaning pushing product through specialty doors, specialty retailers, and successfully pushing product into a discount channel like a TJ Maxx or Nordstrom, or even an outlet for that matter, it is a tough balancing act to get, overall positive revenue comps and at the same time not diluting the brand. So that, in my mind, is probably the most important factor that hits my radar screen.
Okay, great. Thank you. Another one we have here is, do Stout's clients commonly allocate all costs and expenses to their segments, business units, and product lines?
This is Marc. I'll start, and Chris, you weigh in if you see. I would say yes to a degree, meaning there's some costs and expenses, and again, depending on the purpose. Maybe a normal course, there might be some, clearly direct costs that are attributable to a business unit or a product line, or even a segment for that matter. But at the same time, we also see, because it's hard to do, to fully allocate costs. So we'll often see our clients that probably hold out some expenses and not push them down to individual business units or product lines. And probably the typical expense category that isn't allocated would be like the executive management time, like a CFO or the C-suite or other types of departments. So it's, like I said, there's no common method to do that, and there's various ways to do it, and some of them are easier than others. So oftentimes we'll see some of those hold back and not get a fully allocated expense structure. So.
Yeah, and I would say that in this case where we showed the business unit operating performance and whatnot, just to make an observation, when we've advised on carve-out transactions where you're actually lifting out a business unit so that it's a standalone, that oftentimes there can be some surprises in what the actual standalone numbers will look like. And so you have to take that into consideration when you're evaluating what will be left behind in terms of, the true P&L once you lift out the business unit.
Great, thank you. Another one we have here is, how can the boardroom organize for ongoing financial analysis? Is that by audit committee, or are there other ways?
The audit committee often is tasked with dealing and working with the CFO and other financial professionals in terms of working on the reporting packages and always continuously improving it and whatnot. And I know there are loads of other outside of sort of the internal board mechanisms. There's also a lot of outside education for directors through the NACD and other organizations like that, so that sitting board members can continually improve their understanding of the financial package and whatnot.
Great. Okay, thank you. I think we probably have time for one more question. So do you have a view, Chris or Marc, on what company management should do with the transaction proceeds?
Chris, I guess from my perspective, I think it would be tough. There was a bullet point on the slide about paying a special dividend shows. I think, frankly, that's probably a distant third here. So, this company is already kind of, has a high degree of leverage, if you will, at least relative to the comps and what we look at in terms of EBITDA or enterprise value and debt. So, look, there could be some investment in some other areas, particularly to grow online. But I would tend to think that maybe the pay down of the debt of the $105 million in this case would probably be a good use of proceeds. The company has already got some other good, headwinds as far as its trends, potentially in terms of generating internal cash flow. So that'd be my view.
Yeah.
Chris, I don't know if you have any other thought.
Yeah, I think if you were to do a dividend in a situation like this, it wouldn't be very well received just given the headwinds. But even in healthier situations, I think when you're paying a special dividend, you're signaling to the market that you don't have better opportunities to deploy that capital within the business and growth opportunities. And so it's kind of a tough signal oftentimes to the marketplace.
Great. Thank you so much. I think that just about does it for our time today. So I just want to say thank you, Chris and Marc, for this presentation today, and thank you all for joining us. If you do have any questions for our presenters, please feel free to contact them at the information listed on this screen. And again, we'll be in touch soon with the webinar slides and recording. Thanks and have a great day.
Thank you.